So you open up your favorite Neobank app, marvel at that beautiful zero-friction interface, and you can't help but wonder, how exactly does this actually work? It's really tempting to think that building a digital bank is just about designing a modern, colorful UI. But here is the hard truth. A slick mobile app doesn't make you a digital bank. The engine underneath does. Building a true neobank is about constructing a highly regulated, massively complex financial engine. One that handles people's money securely, reliably, and in real time, without ever blinking. It literally has to be bulletproof. Hey everyone, and welcome. I'm absolutely thrilled you're tuning in today because in this explainer, we're going to completely demystify modern digital banking architecture. We're going step by step to look at how a neobank is built from scratch. We are looking past that glossy front end, right down into the vault. I promise you a clear, structured roadmap that will completely change how you view the financial apps sitting on your phone right now. Okay, let's dive into this. We've got a lot to cover, so here is our agenda. 1. The monolith versus the cloud. 2. Anatomy of a neobank. 3. Core ledger and payments. 4. APIs and microservices. 5. Licensing and compliance. And 6. The implementation roadmap. Starting off with Section 1, the monolith versus the cloud. To really understand where we're going, we first have to understand what we're leaving behind. Traditional banking architecture was built for a completely different world, right? A world where banking meant literally walking into a physical branch between 9 a.m. and 4 p.m. Those legacy banks, they still rely on rigid, monolithic code running on aging mainframes. They process transactions in batches, usually overnight. Think about how frustrating that is. If you make a transfer on a Friday night, it might not actually clear until Monday morning. Contrast that with neobanking. Modern digital banks are entirely cloud native. They give you true 24/7 availability with real-time processing. When your customer taps their card for a coffee, they expect an instant notification on their phone, right then and there. You just can't achieve that instant agility or the ability to scale up your servers during a massive viral marketing campaign using some old mainframe. You absolutely need a composable API architecture running smoothly in the cloud. Moving on to Section 2, Anatomy of a Neobank. Let's peel back the layers here. Now, what's really interesting about this is how developers assemble these standard, well-known Lego blocks, but with incredibly strict enterprise-grade constraints. For the front end, you'll see apps built using React Native or Flutter. That lets developers create iOS and Android apps simultaneously, ensuring every single user gets the exact same features at the exact same time. On the back end, Java and Go are absolute powerhouses for complex, high-performance transaction processing, while Node.js handles those high-volume network requests. But honestly, let's focus on the database layer for a second. PostgreSQL is incredibly common here because it's ACID compliant. That's atomicity, consistency, isolation, and durability. Why does that matter to us? Well, imagine you try to withdraw cash from an ATM and transfer money out of your app at the exact same millisecond. An ACID-compliant database ensures the system locks the balance, processes the requests perfectly in sequence, and guarantees your money doesn't literally disappear into thin air if its server crashes mid-transaction. Finally, everything is packaged neatly in Docker containers and managed by Kubernetes. That's what gives the bank the magic ability to seamlessly spin up more capacity when traffic spikes. Which brings us to Section 3, Core Ledger and Payments. This is the absolute heart of the system. If a neobank were a living organism, the core ledger is its brain. It is the definitive financial source of truth for the entire institution. It manages every single account balance, records every tiny fee, tracks every transfer, and holds the entire history of the bank. Unlike those old batch process ledgers that reconcile at the end of the day, a modern core ledger ensures real-time accuracy across the entire system the very second a transaction occurs. Without a rock-solid, deeply reliable core ledger, the whole digital bank just collapses. It's that simple. Let's see how this actually plays out in a transaction. Imagine a user hitting send on their app to pay a friend. Boom! First, the user initiates. Second, that request fires instantly via an API to the backend servers. Third, and this is crucial, the system pauses to perform automated compliance checks, AML, fraud screening, just making sure everything is legal. Fourth, it routes through an external payment provider or clearing network. Fifth, the core ledger officially updates the balances. And finally, the success notification pops up on the user's screen. This entire massively complex orchestration springs into action and completes in just a fraction of a second. It's honestly kind of mind-blowing. Let's look at Section 4, APIs and microservices. So how do all these moving parts actually talk to each other without tangling into a huge mess? I absolutely love this vivid metaphor from our sources. If the core is the brain, APIs are the nervous system. An API-first approach means every single feature,
Whether you're scanning an ID card during sign-up or executing a massive wire transfer, can connect seamlessly to external providers and internal modules. It is the secret sauce behind composable banking. You aren't building a giant, immovable block of code. You're building a highly flexible network of interconnected services. To really hammer home why we use microservices instead of monoliths, imagine a busy restaurant. In a monolith setup, one single person takes your order, cooks the food, pours the drinks, and cleans the tables. If that poor guy gets sick, the entire restaurant has to close. And crazy enough, that is exactly how legacy banking software works. But in a microservices architecture, you hire specialists. You have a dedicated user service, a separate account service, a transaction service, a notification service. Think about the fault tolerance here. The notification service is the person pouring the drinks. If they drop a glass, maybe users don't get a text message right away. But the chef, the transaction service, is still cooking. People can still spend their money. It gives a neobank incredible reliability and the agility to update one feature without breaking the whole shebang.
All right, moving into Section 5, licensing and compliance. Let me be completely clear here. The most brilliant technology in the world is completely useless if you don't have the legal right to operate. The crucial point is that you have to align your tech and license strategy with your business model. Basically, you've got three main paths. First, the full bank charter. This is the holy grail. It lets you hold direct deposits and lend money out, but it takes 2 to 4 years and millions of dollars in capital. It is almost never the right first step for a startup. The middle path is the EMI, or Payment Institution License, great for e-money and digital wallets, taking about 6 to 18 months. But the fastest route to actually validate your product in the real world, that's the third path, partnering with a sponsor bank or using banking as a service. You basically leverage another bank's license to get an MVP to market in just 6 to 12 weeks. But regardless of the license you choose, compliance is not an afterthought. You can't just bolt it on later. It must be deeply embedded into every single transaction flow. You absolutely need automated KYC using AI for fast identity verification. You need continuous AML transaction monitoring. You need automated sanctions and PEP screening, that's politically exposed persons, to ensure you aren't accidentally harboring funds for international criminals. And if you're issuing payment cards, strict adherence to PCI DSS for secure network architecture is completely non-negotiable. Regulators are going to demand this from day one, for sure. Finally, Section 6, the implementation roadmap. Let's pull all of this together. When you sit down to implement, you face the classic build versus buy decision. Building a core ledger completely in-house gives you maximum flexibility, but it can cost upwards of $5 million and take 2 grueling years before you even see a single customer. Buying a closed vendor solution is faster, but you risk vendor lock-in, where you're trapped paying their fees forever. Actually, a brilliant middle ground that a lot of modern fintechs are using is a white label platform with source code ownership. It drops your launch time to just a few months, vastly reduces upfront costs, and you still own the code to customize things later on. It's a real sweet spot. So for a fintech entrepreneur, the safest rollout sequence minimizes risk and capital. Basically, don't build the whole bank on day one. Start with phase 1. Use a banking as a service MVP for quick market validation. See if people actually want your app. Once you prove that product market fit, move to phase 2 and acquire your own EMI or PI license for greater independence. Finally, advance to phase 3. Apply for that full bank charter only when holding massive deposits and lending money become absolutely central to your economic engine. We have covered a ton of ground today, from the monoliths and the cloud to deep core ledgers, microservices, and regulatory ladders. It is a massive undertaking. So I want to leave you with this provocative question to ponder. Are you building a bank or just a banking app? Because as we've seen today, true digital banking isn't just about incredible screen design. It requires mastering the deep, highly regulated, flawlessly orchestrated architectural engine that lives right beneath the surface. Thank you so much for joining me on this explainer. Keep exploring and keep learning.